Hello, welcome to the European Open briefing for Wednesday, April the 25th. I'm Rafi Barajan, currency analyst at XM.com, and we're going to be having a look at the latest developments in the currency markets today. The US dollar is holding fairly firm near those multi-month highs it touched yesterday. But although the dollar is getting a major boost from rising treasury yields, that spike in yields is actually weighing on equities. We're seeing sharp losses in Asia this morning, and we also saw big losses overnight in the US. The euro remains fairly subdued. Main focus is the ECB meeting tomorrow. Commodity-linked currencies aren't doing too well, obviously, and the Kiwi both extending their losses. The loonie is somewhat steadier. And oil prices have eased, mainly Brent crude from yesterday's fresh highs, as Trump and Macron discussed the possibility of a new Iran nuclear deal. So let's take a quick look first at the major pairs and equity indices. We can see dollar index, dollar yen, both firmer this morning. Euro and pound weaker. Aussie and Kiwi are also down. They're down quite a bit, actually, by around 0.5%. The loonie is also slightly weaker. Gold prices are down, despite the fact that the sell-off in stocks has led to some risk off this morning. Oil prices are slightly firmer at the moment, but if you look at it in the equities, we can see most major indices are in the red, and Europe has also just opened lower this morning. So let's take a quick look at the US dollar now. We can see that week-long rally in the greenback. The dollar index yesterday rose to more than 3 months high of 91.08, but has met some resistance at the 91 level. It's currently just a short distance from that top from yesterday. Dollar yen, though, is looking slightly more bullish. It is attempting to break above 109.20, having risen as high as 109.19 yesterday. That's a 2.5 months high. So apart from the rising treasury yields, which yesterday broke above 3%, that's a 10-year yield, rising about 3% for the first time since January 2014. We also have more solid US data. We saw the consumer confidence index yesterday rising unexpectedly to 128.7 in April, coming close to February's 17-year high of 130. New home sales also rose more than expected in March in yesterday's data. So all in all, it's looking fairly bullish for the dollar in the very near term. And let's take a look at yields now. We can see the 10-year yield above 3%, currently at 3.01%. But if you look at the Dow Jones in the lower chart, we can see it fell sharply yesterday, falling back below its 50-day moving average. Though in comparison to the slide we saw back in early February, so that's when the 10-year yields, the increases in 10-year yields started accelerating, sending jitters across financial markets. And although this time around they did manage to break above 3%, it's somewhat more limited losses in equities. I guess markets had time to get used to that. Also, we are having a very strong earnings season at the moment, though there are some concerns that the record earnings have peaked, but the main focus for the markets, at least in terms of Forex markets, is the rising yield differential between the US and its major peers such as Japan and Germany. So we're seeing actually German and US yields widening to the most since in 29 years. So that is giving a major boost to the US dollar at the moment. And looking at the euro, it's struggling. It's coming close to yesterday's 2-month low, 1.2180. We also had disappointing German IFO numbers yesterday, raising concerns about growth in Europe's largest economy slowing. So that puts even more focus on the ECB policy meeting tomorrow, where we're of course going to have also a press conference with ECB President Mario Draghi. The pound also looking rather sluggish at the moment. It attempted and failed to break above the 1.40 handle, having fallen to 1 month's lows yesterday, and But today we are seeing a bit of support for sterling coming from M&A activity, and also some hopes of perhaps that the UK would remain in the customs union once it leaves the EU. Let's move on now to the Australian and New Zealand dollars. Both currencies still falling against the US dollar. We can see they've been falling for much of the past week. The Aussie did fall to a fresh 4-month low of 0.7560 earlier today. So over the past week we had disappointing employment and inflation numbers out of Australia, and together with the combination of rising US yields and expectations of when the RBA will raise rates, so all of that is creating a lot of downside pressure for the Aussie dollar pair. The same applies for the Kiwi, which has slumped to a 3.5-month low of 0.7076. It has now broken below the 0.71 level and has erased all of its year-to-date gains. And we also had some disappointing inflation numbers out of New Zealand as well. Inflation in the country is now very close to dropping below the RBNZ's lower target band for inflation of 1%. So that raises the prospect of not just rate hike expectations, the timing being pushed back, but also perhaps even a rate cut if inflation continues to remain low. Moving now on to the Canadian dollar. So USD CAD has met resistance around the 1.2860 level. So that's support if you're looking at from the Canadian dollar's perspective. Some more signs of progress in NAFTA. Yesterday, President Trump said that we're doing very nicely with NAFTA, so that is so far containing the loonies losses. We're going to hear more from Bank of Canada Governor Stephen Poloz. He has been talking in recent days. He testified again at another parliamentary committee on Monday, and had also made some remarks last week as well, all of which were fairly dovish. So we could see the loonie breaking below that support of 1.2860 if Poloz once again sounds a very dovish tone. And looking at oil prices, they are providing a little bit of support to the loonie, but overall oil prices are off their highs. Brent crude yesterday rose to fresh 3.5-year high of $75.47 a barrel. WTI, though, didn't manage to repeat that. The last high came on Monday. Rising US output is weighing on WTI prices. Yesterday we saw an increase in US crude stocks in the API's weekly inventory report. We've got the official EIA report coming out later today. But the main reason why oil prices are off their highs is yesterday President Trump and Macron talked about the possibility of a new nuclear deal with Iran in an attempt to contain Iran's missile program. So if they do go ahead with something like that, it would mean that President Trump is unlikely to pull out of the current nuclear deal, and that would mean no new fresh sanctions on Iranian oil output. That's it from me. We don't have any major data coming up later in today's economic calendar. Have a great day.